on the 15th, we had sell side here. Then we dropped down. Classic signature of London Open is a stop run. London Open classically seeks sell side or buy side liquidity. You don't have to have the confidence to go in and buy the sell stops. I can. My students have learned how to do that, but it's a very, very hard thing to learn because you have to see years of this type of stuff to desensitize you. It's easier for you to wait for this run here and then judge, does it have displacement higher? Swing high. After it takes stops, fair value gap, it drops down into it here, rally. We want to see energetic run once it clears this high. Does it do it? Yes. In itself, at this time of day, is 3:55. What time of day is that? London Open Kill Zone. Between 2 o'clock in the morning and 5 o'clock in the morning. This fair value gap right here is the silver bullet for Euro for today. You only need this low right here to trade to. There. What time is that? 4:20. Sorry, just a joke. Some of you probably won't get that. No, I don't smoke weed. But there's your silver bullet for London Open. And it rallies up to what? The low of that fair value gap I told you on the 13th of June. That is what? What is that? That is your low-hanging fruit objective. You don't need it to go all the way up to mean threshold, which is half of that shaded area in purple, which is the order block on the daily chart. You don't need it to go there. It can, but you are framing on the basis of getting into that fair value gap. Now, why am I not using the low of the order block? Because that gap is there. The inefficiency takes precedence over the order block. Yes, the inefficiency takes precedence over the order block. This is where you would see it reach for minimum. Does it react there? Sure it does. Trades back down into what? What's it trading into? A low, high, lower low. What does that make this? A bullish breaker. Extended in time. What time of day is that? New York Open Kill Zone. 7 o'clock in the morning to 9 o'clock in the morning. There's your little sweet spot. What does it do? Rallies. How high can it go? Well, we have to determine a fulcrum point. Fulcrum point is here. Why is that important? If it runs through this high, we can start doing measurements in the form of standard deviation. So we can take that low, project it up this high here. Standard deviation, -2, -1.5, 1. This is a measured move. Okay, so from this low to that high, a classic ABCD type thing or measured move. And that's it right here. You want to absolutely have the lines portion of your trade off there, because what else is that in close proximity to? The high of the order block. Remember this shaded area here. This shaded area is, let me drop up into, or not drop up, but go up into this up close candle right here, right there, right above my cursor. That's what I'm highlighting here, the low to the high of that. That's what I'm showing. So back down in, measuring that low to high, and this is the fulcrum point, meaning that when price trades to it and through it, it has to go through it before you can get any of these measurements. That's the measured move. Lines portion of the trade should be taken off there because it's in close proximity to the high of that order block. It could very easily stop there and consolidate into the rest of the day and then continue on Sunday into Monday. But allowing for continuation, when it gets to the high of the order block, you need to consider taking a partial there. -1.5 and 2. That's 2 times this move here. Whenever you get that type of move, that's very, very extended. So two standard deviations. I teach in mentorship that two standard deviations of like the Asian range or flout or central bank dealers range, central bank digital currency, hear that? Central bank dealers range, those ranges that I use for measuring protraction and how far a high or low can move before it makes it. That same principle applies here with all price swings. -2 standard deviation is one of those levels where there's a lot of reason for you to be wanting to be either out of the trade or have such a small little piece on. If you're going to leave a runner on, it's about at that time we usually peter out, especially if we do so when time is met, and that being 10 o'clock in the morning, New York local time, to noon. That's London close. So for your notes, especially for the folks that are brand new, when markets are going down, or we're expecting the daily candle to be a down close candle, between 2 o'clock and 5 o'clock in the morning, generally you're going to see the high form. And generally, the New York session between 7 o'clock in the morning and 9 o'clock in the morning, New York local time, will create a continuation pattern. Now, sometimes there's a reversal of that, where London creates a high, sells off, and then New York runs out the London high, but then reverses and makes the lower close in the day. Those are always on the heels of a high or medium impact news driver. That's the only time that occurs. So how do you know when the low is not going to be taken out or the high is going to be taken out in London and you can trust the New York session? I just told you. Man, I should have charged money for this one. So we can see there's a lot of consolidation in here. We had a high. It ride above it. If I was long on euro, this is running down equity. This is the principle. You see me do it all the time in trades. If I'm long, and admittedly, I was sleeping last night preparing for all this, so I didn't trade euro, and I've been trading Forex for a while now. As soon as it trades above this high, you want to be taking partial and exiting your position. It's offset distribution, and the principle is running down equity. That means you're selling to buy stops. You're selling at new highs. You're buying low and selling high. Where do you define high? Every time it takes out a swing high. When you're long, if it's long in the tooth or it's been going for a long time, like we did here since 8 o'clock this morning, it's good money practice for you to be selling every time it makes a new high if you have position available to do so. In my personal opinion, if you look at what we're seeing here, do you see how the euro has made higher high and the dollar didn't make that lower low at the same time? Market symmetry suggests that in a perfect world, the US dollar should have made a lower low there in concert with the higher high in euro. This is a USDX SMT divergence. That means dollar, which is USDX, and euro are not in agreement with what they've done at a time of day that is critical, London close. So this would make me very, very cautious to expect higher prices, and I'd be real content with closing all of my position in longs on euro dollar and going into the weekend happy that I've destroyed it. So when I'm looking for SMT divergence is, I've never really settled on the real name for it. It's a smart money technique or smart money tool. I use it interchangeably. It's just a matter of looking at the relationships between closely correlated assets or inversely correlated assets, meaning that euro dollar usually goes higher when dollar goes lower. But if you look at times when they don't agree, so if dollar makes a lower low, a symmetrical market is a euro dollar going higher high. A euro dollar making a lower low and a dollar index making a lower high, that is not symmetrical. They have to agree. So euro, higher high, lower low in dollar. Euro, lower low, higher high in dollar. If ever at any time that it's doing that during key times of the day, which key times is the day for Forex and currency pairs? London open, New York open, London close. Yes, you can trade Asia. Yes, there's opportunities in Asia, but the scope of this workshop today, I don't want to focus on the lowest volatility. I want to take you to where the meat of these daily range moves and for the weekly opportunities that are available. I'm telling you how to go in and see where these algorithmic price swings are going to occur. Okay. Look in here. Is there a gap? lowest down close candle. Now, the ICT, you said you used all the candles. Why aren't you using both of those candles? That candle's outside of that gap. Isn't it outside that shaded area? So what do? You use the down closed last one. You thought you knew under order blocks. You don't know anything yet. Bullish order block, down closed candle, trades into it. You want to see it repel price. Does it repel price? Yes. So at this point, you can take this entire range now. For entry, you're going to use the down close. For support, whether the information is going to continue offering institutional sponsorship, the price is going to continuously work off that level, then you can take this range and then apply it here. But the entry would be on that lowest down close candle. I already hear the people hissing. This is all hindsight. It supports it here, supports it here. Look where the bodies are stopping. See that? Why am I not using this down close candle and this down close candle ICT? It's inside the shaded area, right, of the gap. We have to use the outside of the range. Okay, so we're inside of all this external range liquidity. We have to use the PD array that's made available inside of that, and it's separated by this this up close candle. So that breaks the continuity of down close, up close. That's a change in the state of delivery. Then we go back into down close, down close. So the change in the state of delivery is the open on this price there. But for entry purposes, we use that last down close candle. But for supporting, for a reclaimed order block, go back into month 4 of the mentorship. These two down close candles, it's being reclaimed here and here. And we can see that the opens and closes here, that's supportive. And then we have one more little wick through it. Because why? The wicks do the damage. You don't rush your stop loss. Don't rush it up. Market breaks above here, then takes off, clears the buy side, and then we've been expanding since. Let's see if I can scrunch this up a little bit. So we have a little bit of range still here, but ultimately we're aiming for this. That's a perfect delivery if we can get up to that point.